You're listening to Batting 1000 with Dale Vermillion, where heavy hitters from mortgage, real estate, and business share their secrets for lasting success. With your host, award-winning sales strategist and industry icon, Dale Vermillion.
Hello, Batting 1000 audience. Dale Vermillion back with you, and so glad to be with you. And I am honored today to have a very distinguished guest. I've got Logan Mohtashami with me, who you probably know him as the housing data analyst, financial writer, and the blogger covering the U.S. economy in the housing market. He has been frequently quoted in Bankrate, frequently quoted in Bloomberg Financial. He's the lead analyst for HousingWire. So if you saw the Clayton Collins interview that we did a couple months back, him and Clayton worked together very closely. He's been a speaker all over the country and is a recurring guest on Bloomberg Financial. So you may have seen him on TV shows out there. And he is known in social media as the chart guy. By everybody else, he's known as the housing guru. And that's where I'm going with today, Logan. Logan, welcome. I'm so honored to have you today.
It is great to be here. Thank you.
Well, we got a lot to talk about, but before we get into the marketplace, which I know everybody's chomping at the bit to know where rates are going, where the housing market's going, where inventory's going, all of that stuff, I want to start with your background, and I want you to help our audience know a little bit more about you. I love this detail that your family started in the mortgage business in the 1950s, that your dad started in mortgage in 1979, just a few years before I did. I started in 83, so we're pretty close, which does that mean I could be your dad? I'm not sure about that.
It pretty much means it could be my dad.
So that's fun to know. And you actually spent 20 years in the business yourself, both as a processor and loan originator, which is going to be really make this an interesting conversation. Tell the audience a little bit more about you and your background and just some of the things that you've gleaned over your years and that you think are critical for a loan originator or a manager today to know about your background.
Well, I started to get into finance in 1996 by trading stocks. In our family, we've had our own mortgage company here in Southern California since 1987. And also in 1996, I started working in the mortgage industry. I eventually got my LO license in 2003 and been a loan officer up until June of 2020 when I retired. By 2010, one thing led to another. I started writing about finance, real estate, created my own blog, and now it's turned to this 11 years later. So I'm pretty much just a data geek nerd. That's what people know me as. And I literally just do charts 24/7. And having a financial lending background, actually, I thought was an advantage for me into the macroeconomic work, just because the American economy is so based on credit. And, after the housing bubble crash, there was when you have internally knows of how the mortgage industry works and how debt structure works, it really helped me kind of explain how, the loan profiles in America post 2010 have looked better than ever. It's a big framework of my discussion and talking points over the years. So it has actually benefited me on the macroeconomic side, having a financial lending background. And yes, our family in general has been in banking since the late 1950s. So this is kind of all we do.
That's really cool. I've spoken at many conferences with guys like Doug Duncan and Mike Frantantoni, so I know those guys. And it's interesting how unique your background is, having been in the mortgage originations and done that and familiar with it your whole life, which really makes a different perspective. So let me start with this question. How did you get to HousingWire? How did you move out of that into HousingWire and get where you're at today?
Well, in 2019, with my financial blog and the work I've done there, I've accumulated a nice big following just on macroeconomic discussions and specifically for housing. And Clayton asked me, do you want to write for housing? And at first I wasn't going to do it because I wasn't sure how much I wanted to continue this, but I knew so many loan officers around the country and they were like, yeah, you should do HousingWire. We'd love your take on it. So really it was because of kind of the relationships I've had with LOs that I thought, this will be good in the sense that this audience will be bigger and I could write maybe in a way that they could understand and it'll be beneficial for them, because I'm really a macroeconomic cycle person first, housing the secondary work, but it all kind of moves together with the bond market and mortgage rates and everything. So I thought it'll be useful. Then COVID happened, So and for HousingWire, I think what a lot of people know me for is writing what I call the America's Back recovery model on HousingWire on April 7th. And my job is to basically show people how progressions of economic cycle works. And I really believe that we were going to recover in 2020. So I'm just a nerd that is trying to show you the pathway on where I think the economy is going using data sets and try to get people to ignore the noise out there, because there's a lot of noise in the financial discussions through social media sites. So, and two things I've always said, economics, if it's done right, should be very boring. And you always want to be the detective, not the troll.
Yep. So let's begin. And by the way, I wouldn't be calling yourself a nerd. You're very articulate. I've seen you many, many times. So I think we can dispel that right away and just get to the fact.
Well, nerds can be articulate, So I try to be as talkative as I can.
Yeah, I'm going to use the term genius in that. How about we use that one? That'll work a little bit better. So let's go right to the white elephant in the room that everybody is concerned about today, and that's where interest rates are going. Interesting to know that you have a little different perspective. Now, let me just share a couple of things, and I want to hear you kind of speak to those. The MBA, as you know, forecasted this year about a 6% increase in the purchase market in 2022 over 2021, with a record year of 1.74 trillion as of the last forecast that they did in production. They're also projecting a 63% approximate decrease in refinances, and a lot of that stems off of the rate increases that we're seeing, with a projection from the MBA that it's going to be around 4% by the end of the year, projection from Fannie and Freddie about 3.4%. I would love to hear your perspective on where you think this is at. And I know a lot of that's driven by inflationary concerns versus, the Fed or Treasury. But I know you very much follow Treasury, and I want to hear just your perspective and kind of your thinking behind that.
So I'm a bond market guy. I'm a 10-year yield guy. I'm not a mortgage-backed security person or anything in that regards. I actually don't believe in targeting mortgage rate levels. I believe just following the 10-year year channels. So just to give you a good example, I started incorporating this work in 2015, and in the previous expansion, all my prediction articles said the 10-year yield is going to be in a range between 1.6 to 3%. So when the recession happens, it'll go lower. If you look at the long-term downtrend since 1981, it's still intact. If you look at the long-term downtrend in rates and bond yields, really since 900 years ago, it's been a downtrend, right? So the trend is your friend. So regarding with COVID, when that happened, I thought the 10-year yield could get negative to 62 basis points. So that's where we're heading there. The recovery was going to happen in 2020. So the ranges that I use is 0.62% on the 10-year yield to 1.94%. So basically 2.375 to 2.5% is the low end. The upper end is about 3.375 to 3.625. The 1.94% level on the 10-year yield has been my main talking point since 2019. Even in my 2020 forecast, I talked about, listen, until we break over 1.94% in the 10-year yield, don't talk about 4% mortgage rates or anything in that regard. I know everybody talks about inflation and growth. I don't believe that's the case. And I'm going to explain why. If you look at economic data currently, we've had the hottest economic growth in decades. We've had the hottest inflationary data in decades. If we were just basing off of that, mortgage rates would be 6.5 to 7.5% today, right now. The 10-year yield would be over 5%, actually, over 5.25%. That's not happening. We are still under 2% on the 10-year yield because it respects the downtrend in the bond yield. So I basically work off of that. What's different this year than, I'd say, last year, I can make a premise on how mortgage rates get over 4%. It has nothing to actually do with inflation or growth. European bond yields and Japan 10-year yields, those things need to rise, right? Because our 10-year yield can't really get too much higher than theirs. And that's currently what's happening. It's not enough yet to get the 10-year yield over 1.94%, but that was the whole premise. Because if we're using inflation and growth, the 10-year yield currently is at levels to where in the previous expansion, people would be talking about a recession because it's under 2%. So it's not that. To me, it's more technical bond work than anything else. So you can get above 4% mortgage rates, but it needs Germany and the 10-year yield in Japan all to rise, which they have, but it's just not enough yet. And that's why I create ranges in the 10-year yield to go with mortgage rates. And now the Federal Reserve is going to try to cool the economy with rate hikes. The rate of growth of the economy peaked last year. We're not a super fast growing economy anyway. Some of these things will moderate in terms of economic data and the rate of growth. So the question is, does that bring bond yields, let's say back to 120, and we're back to 3% or 2.75%. That to me is how I'm looking at this currently. But we do have a premise to get above 4% mortgage rates, but it needs the 10-year yield in Germany and Japan to rise up and all global yields to rise together to get there.
So here's the key question. What are you projecting, or what do you believe rates are going to get to? Because I know in the conversation you had with my son Jake, kind of pre-interview on this, you talked about the possibility of they could be under 3% by the end of the year. Tell me where you're at.
Yes. So sticking with the range, if growth slows down, let's say you get more of a stock market correction, the data starts to moderate, bond yields could come down off of it. The question for me is that, do we go under 1% on the 10-year yield again? Do rates get back to 2.5 to 2.75%? Within that channel, which is still intact, actually, even today, the 10-year yield is at 1.84%. That should stick. But the question is, do we have a little bit of rates above 4% and then come back down? Because if you just follow the downtrend, we still have some upside on the 10-year yield to about 2.70% for that long-term downtrend since 1981. So I think rates just move in a range, and that's really been a lot of my work over the years. I think the one time in the previous expansion where I was really tested was in 2018. 10-year yield was at 3.25%. Everybody had 5, even some people would talk about 6% mortgage rates. I was very adamant back then, even at an economics conference, saying, no, the 10-year yield is going to go down in 2019. Mortgage rates are going to go back down. It just follows a long-term downtrend. So that's how I operate. I don't really operate on a lot of different things that maybe other economists do. So I just basically go where I think the 10-year yield is going. And I think one misconception that has happened in the last 10 years is that people are told that once the Fed stops its QE process, bond yields would skyrocket and rates have gone up higher. This has actually never occurred in the previous expansion. When QE1 ended, bond yields went down, so did rates. When QE2 ended, bond yields went down, so did rates. When the taper was closing off in 2014, bond yields went down and so did rates. When QE3 ended, that was supposed to be the end of the world, bond yields went down and so did rates. So to me, it's inflation expectations, where the ranges are of the bond market. That to me is more important, and I think showing my historical work on this, it has been more correct than maybe other assumptions on where rates should be. So we'll see if the economy slows down fast enough to drive yields much lower, but we stick in that range. But one thing, I mean, for me, it seems like I'm rooting for high rates just because there are issues with the housing market that we'll discuss it later. The only thing that could cool housing down is a 10-year yield above 1.94%. I even wrote this in the summer of 2020. I said, listen, everyone should worry about home prices accelerating, not crashing, so much that for HousingWire, I coined the phrase forbearance crash bros. In the summer of 2020, just because the grifting of housing is done by very untalented American citizens who have basically spent their adult life telling people when housing is going to crash. So coined the term forbearance crash bros. There's a bunch of people on YouTube's, Twitter, and Facebook. It was going to be a disaster for them, and now we can see what's happening. Inventory in 2022 are at fresh all-time lows. The only way you could create more days on market is rates above 4%. This happened in the previous expansion 2 times, but again, it's really hard to get the 10-year yield above 1.94% since 2019.
Got it. Well, and as I remind my audience all the time and everybody that I've trained over the years, at the end of the day, your dad went through the same market I did when rates were 21, then down to 17, then down to 15, down to 12, and people bought homes like crazy. It was one of the biggest booms we ever saw in U.S. history. So
yeah, it's interesting, that perspective, because when people say demand's going to crash, when we had 5% mortgage rates in 2018, we had near 6 million total home sales. So I think the perspective, do higher rates crash? Well, if rates went to 8 or 9 or 10%, something, but look at the U.S. housing market post 1996. Post 1996, because the civilian labor force is up and mortgage rates went below 8%. It's really rare in America to have under 4 million home sales in any month. It authentically really only happened toward the end of 2008, and there was a lot of credit tightening in that process into a weaker demographic package. So millions and millions and millions of people buy homes each year. That's perfectly normal. Where rates were at 5% or rates are at 2.5%, the marginal home buyer does get hit when rates rise, but it's really hard to have a kind of a demand crash when you have the best housing demographics ever recorded in history. And that's the unique period of my work for the last decade, is talking about years 2020 to 2024 being a once in a lifetime event. And I was really adamant on pushing that, especially early in COVID, that no, housing isn't going to crash again. People buy homes every year. It's a very normal thing.
Well, and for anybody to even think there's a possible demand crash is pretty interesting to me when you consider that last year CoreLogic told us that property values went up 18% in the U.S. on a national average. Rents last year also went up 18% last year. So why would you ever want to rent if you can get into home ownership, even at a 4%, 4.25%, 4.5% rate? It doesn't really matter. And what I've seen in my almost 40-year career is as rates rise like they do now, you see actually a flurry of activity into the purchase side of the market, because it's kind of like when the stock market shifts. People kind of chase the market is what they do. They want to get in before the rates get too high. They want to make sure they take advantage of that marketplace. And on the refi side, that's going to be the impact on the rate and term. But if you're working on cash out debt elimination, which with the liquidity needs that consumers have today in this marketplace with inflation, there's plenty of opportunities to do refis too. We'll see obviously a decline, but I don't think to the levels that's being predicted. What are your thoughts on that?
Yeah, as rates have moved up, you actually you've created higher rate and term supply for future when rates drop. So it is something I talked about in 2017 and 2018. As rates had gone up, moved up toward 5%, I said, okay, so we've actually created a nice little mini wave of rate and term refinance. And so one of the things I talked about in 2018, I said, hey, listen, I know the Wall Street Journal had 50 economists. Everybody said rates are going to well above 5%. Rates are going to go down next year. So get your rate and term refinance people ready, because the whole purchase money had been at higher rates. Even right now, even let's say 3.5 to 3.75, if you just get a downward shift in the 10-year yield, you've got another rate and term refinance group right there just from the recent purchases. So it ebbs and flows. It's historically, it just follows a downtrend. So rates can move up and down within a cycle. And then when the next recession happens, they go down lower again. The question is, does the 10-year yield ever go negative here in the U.S. Like it does in Germany and Japan? In time, it should be that case. But the trend is your friend. That's what I always say. So don't worry about inflation or rates, in the late 70s or 1980s. That's a whole different kind of a marketplace in terms of the 10-year yield getting back up there. Not going to happen.
So a lot of that crazy fear that's out there really should be optimism. As I've been telling everybody, this is a very opportunistic market if you look at it from the right vantage point. And I love the fact that, we're talking about, we're building future markets for our consumers and for ourselves, and we should celebrate that. And there's still plenty of business. I mean, even on the refi side, for those people who are in very low rates today, as I've shared a million times when I've trained, you look at consumer debt, and you look at the equity that's been created over the last decade in the United States and the amount of equity that people have today. And if you just take $10,000 of consumer debt, which averages about a $250 monthly payment, and you embed that into a 25-year, not a 30-year, 25-year term, 3.5% rate mortgage, it's only a $50 payment that you're dealing with. So you're literally creating a $200 savings which is applied back, does two things. It cuts your term by over 10 years on your mortgage, and it really eliminates that consumer debt overnight. So there's so much opportunity in the market, whether rates go up or not, if you're viewing the market from the right vantage point. I think that's the key to everything.
Yeah, the nested equity portion of U.S. homeowners' balance sheet has never looked better.
Yeah.
And people have to realize 40% of all homes in America don't have a mortgage. So you're talking about, and we actually, debt expansion adjusting to inflation is actually still negative from the housing bubble peak. So it wasn't like we had a massive credit boom from, let's say, I use these mortgage banking purchase application charts to kind of show that the market that we had from 2002 to 2005 is not here. So we have a lot of American homeowners who have a lot of nested equity, but the key term is fixed low debt costs versus rising wages. Mortgage payment as a percentage of disposable incomes, all-time lows. Household debt payments, just because your mortgage debt is your biggest thing on your balance sheet.
Yep.
Versus disposable income, all-time lows. So the consumer is in really good shape. We see it in FICO scores, cash flows, and every single data line. The American homeowner has never looked better on paper.
Hey there, audio listener. Producer Jake here. Thanks so much for listening to the public version of this episode featuring HousingWire's lead analyst, Logan Mohtashami. When it comes to the 2022 market, look, there's a lot to discuss, and Dale and Logan get into just about all of it in the full members-only version of this episode. So here's what I need you to do. If you want to listen to the full episode, visit dalevermillion.com/Diamond Club to join a members-only club that has exclusive access to the full-length conversations Dale hosts with incredible guests. As a member, you'll not only get your own personalized feed to listen to Batting 1000 in your favorite podcasting app, but access to the full video interview, plus gain access to transcripts, blog posts, and more. Become a Diamond Club member today by visiting Dale Vermillion. That's DALEVERMILLION.com/Diamond Club. That's DIAMOND CLUB. Thanks for listening.